You wake up to a notification. Your card declined.
Your transfer pending. Your account under review. No prior notice. No missed payments. No obvious mistake. Just a quiet message informing you that access has been restricted. And in that moment, something shifts. Not in your balance. In your control. Because if it can be restricted without warning, then it was never fully yours to command. This is not about isolated errors or rare legal interventions. It is about structure. About how modern banking systems are designed to prioritize institutional stability, regulatory compliance, and systemic risk management over uninterrupted individual access. Restrictions are not accidents. They are embedded contingencies. And contingencies do not require your consent when they activate. The modern financial system operates on layered permissions. Every account, every transaction, every transfer exists inside a framework of oversight. Compliance departments monitor flows. Algorithms flag anomalies. Clearing networks validate counterparties. Regulators define thresholds. The visible interface is seamless. The underlying architecture is conditional. When you deposit money into a bank, the legal relationship changes. The funds become the bank's asset. You receive a claim. That claim is enforceable, but not instantaneous under all conditions. Liquidity constraints, fraud detection, suspicious activity flags, court orders, sanction screenings, regulatory reviews, all can suspend access. Most of the time they do not. But the capacity exists continuously. Capacity defines power. Power that exists does not need to be exercised often to shape behavior. Restricted without warning does not mean confiscated. It means paused. Paused access can last hours, days, sometimes weeks. During that pause, bills remain due. Interest continues accruing. Automatic payments attempt to clear. Economic obligations do not wait for compliance resolution. This asymmetry reveals something deeper. Liabilities move on schedule. Assets can be delayed. The system's default posture is to protect itself first. Consider how fraud detection systems operate. Banks deploy machine learning models trained on historical transaction data. These models identify patterns associated with fraud, money laundering, identity theft, and regulatory breaches. When a transaction deviates from expected behavior, unusual geography, higher volume, irregular timing, the model assigns risk. Risk triggers intervention. Intervention triggers restriction. The decision may be automated. Automation prioritizes speed over nuance. The individual experience becomes secondary to the system's probability threshold. False positives are inevitable. Yet resolution mechanisms are often slower than detection. You must prove normalcy. The system does not need to prove suspicion beyond internal metrics. This is not malfunction. It is precaution. Precaution embedded into the design. The design reflects a world of increasing regulatory pressure. Financial institutions face severe penalties for compliance failures. Fines can reach billions. Reputation risk can destabilize share prices. Executives are accountable to shareholders and regulators. Under such pressure, risk tolerance narrows. Narrower tolerance means broader intervention criteria. Broader criteria increase restriction frequency. Restriction becomes normalized. The normalization of restriction is subtle. You receive an email requesting additional documentation. A text message asking you to confirm a purchase. A notice that a transfer has been temporarily delayed for review. Each event individually reasonable. Collectively indicative of evolving oversight. Oversight expands quietly. Access shrinks incrementally. The late realization emerges slowly. For years, digital banking appears frictionless. Mobile apps enable instant transfers. Cards function globally. Cross-border payments clear within days rather than weeks. The infrastructure feels permanent. But permanence is an illusion sustained by confidence and liquidity. When confidence wavers, due to economic slowdown, market volatility, geopolitical tension, internal thresholds adjust. Threshold adjustments are not broadcast. They are implemented through internal risk management updates. An increase in suspicious activity reports across a sector may lead to heightened monitoring across all accounts in that sector. A rise in fraud incidents in one region may tighten scrutiny globally. You may never know why your account was flagged. Only that it was. Historical precedent shows how quickly access can narrow under stress. During sovereign debt crises, governments have imposed withdrawal limits to prevent bank runs. In Argentina in 2001, deposit withdrawals were capped. In Cyprus in 2013, capital controls restricted transfers and large withdrawals. These were emergency measures. They were also legal. The framework for such measures existed before activation. Emergency powers are rarely created in real time. They are prepared in advance. Preparation signals possibility. Possibility shapes expectation. Expectation shapes behavior. In a highly digitized economy, the mechanics of restriction extend beyond banks. Payment processors can suspend merchants for elevated chargeback ratios. Online financial platforms can terminate user accounts under terms of service clauses that allow broad discretion. Digital wallets can freeze funds pending investigation. Cryptocurrency exchanges can halt withdrawals during liquidity strain. Each platform retains override authority. Override authority is justified as consumer protection. It is also systemic self-protection. The line between protection and control can blur. Control does not require malicious intent. It requires infrastructure capable of intervention. Modern finance is infrastructure heavy. Clearinghouses settle transactions between banks. Central counterparties stand between buyers and sellers in derivatives markets. Payment networks route card transactions globally. Each node has rules. Rules can change. Rule changes can affect settlement speed, collateral requirements, eligibility criteria. When collateral requirements rise in stressed markets, participants must post additional assets to maintain positions. If they cannot, positions close. Closures ripple through portfolios. Ripple effects can prompt liquidity conservation at banks. Liquidity conservation can slow outgoing transfers. No public announcement necessary. Internal prudence suffices. Restricted without warning is often experienced first at the margin. A large transfer triggers review. An international payment delays. A credit line reduces unexpectedly. These are not collapses. They are signals. Signals that risk calibration is tightening. Calibration is continuous. Continuous calibration means access is continuously evaluated. In credit systems, similar mechanisms operate. Credit limits can be reduced based on internal models. The borrower may have perfect payment history. Aggregate data may suggest increased sectoral risk. Sectoral risk informs model updates. Model updates trigger limit adjustments. Again, no rule broken. The rules were adaptive. Adaptability favors the institution. Consider also how banks manage liquidity coverage ratios. Regulations require banks to hold sufficient high-quality liquid assets. If deposit outflows increase in simulations or real conditions, banks may preemptively manage balances. Promotional rates disappear. Transfer limits tighten. Internal risk dashboards influence operational decisions. The depositor sees only outcome. Behind the outcome lies a network of prudential calculations. In economies burdened by high sovereign debt, central banks face difficult trade-offs. Tightening monetary policy raises borrowing costs, increasing stress on households and corporations. Loosening policy can undermine currency stability. If financial stress intensifies, emergency measures may be activated. Emergency measures often involve liquidity injections. They may also involve flow controls. Flow controls restrict speed. Speed is the accelerant of panic. Slowing flows stabilizes institutions. But stabilization can feel like confinement. The asymmetry deepens when considering that obligations rarely pause alongside restrictions. Loan payments remain due. Interest accrues. Penalties may apply. Access delay does not suspend contract timelines automatically. The system distinguishes between asset accessibility and liability enforcement. This distinction benefits the creditor. The creditor controls timing. The debtor absorbs delay. In digital banking, identity verification layers add another dimension. Multi-factor authentication, biometric confirmation, geolocation checks, all designed to enhance security. Security measures can lock accounts automatically after repeated failed login attempts or suspicious device changes. Sometimes the account holder triggers the lock inadvertently. Resolution requires contacting support, submitting documentation, waiting. In that waiting period, autonomy is reduced. Autonomy reduction is rarely framed as structural. It is framed as security protocol. Security protocol increases trust at scale. It can erode trust at the individual level when friction accumulates. Trust is central to monetary systems. Trust that deposits are safe. Trust that payments will clear. Trust that balances reflect usable value. When restrictions appear without warning, trust shifts. Not necessarily collapses. Shifts. Shifts can be subtle. A decision to diversify accounts. A preference for holding some physical cash. A reconsideration of concentration risk. These behavioral changes accumulate slowly. Financial systems rarely fracture in a single dramatic event. They adjust. Restrictions expand during stress. Then retract partially. Then remain slightly tighter than before. Each cycle leaves residual control. Over time, the baseline shifts. Access becomes increasingly conditional. Conditionality is rarely perceived as loss. It is perceived as modernization, compliance enhancement, fraud prevention, digital transformation. Each description accurate within context. Collectively, indicative of structural consolidation of authority. The consolidation is not always centralized politically. It is institutional. Large banks merge. Payment networks dominate. Clearing infrastructures consolidate. Consolidation increases efficiency. It also concentrates override power. Concentrated power can act quickly. Speed is valuable in crisis. Speed reduces individual recourse. The late realization for many is not that the system failed. It is that the system functioned exactly as designed to protect itself first. Protection of the system preserves deposits in aggregate. It may restrict individuals temporarily. The trade-off is rarely discussed in personal finance advice. Because personal finance assumes uninterrupted access. Assumes that compliance equals control. Compliance ensures eligibility. It does not guarantee immediacy. Immediacy depends on institutional discretion at the moment of stress. Discretion is guided by internal models. Models are calibrated by macro conditions. Macro conditions evolve continuously. As global debt levels rise and financial complexity deepens, model sensitivity increases. Higher sensitivity produces earlier intervention. Earlier intervention produces more frequent minor restrictions. Frequent minor restrictions normalize the concept that access can pause. Once normalized, broader restrictions encounter less resistance. This is not a prediction of collapse. It is an observation of design. Design prioritizes continuity. Continuity prioritizes systemic solvency. Systemic solvency may require constraining individual liquidity temporarily. Temporarily can be extended. Extended can become standard. The most unsettling aspect is not the possibility of being restricted. It is the realization that restriction does not require wrongdoing, it requires deviation from evolving norms. Norms are statistical. Statistics do not account for personal context. They account for probability. Probability governs intervention. Intervention governs access. Access is therefore contingent. Contingent on stability, contingent on compliance. Contingent on internal thresholds you do not see. Restricted without warning is not a failure of the system. It is evidence of its hierarchy. And in that hierarchy, individual immediacy ranks below institutional preservation. Once that is understood, the concept of ownership shifts. Ownership becomes a claim within a network. A network that can tighten, quietly, legally, systemically, and often long before anyone publicly acknowledges that the conditions for uninterrupted access were never absolute to begin with.